Hello and welcome to the closing bell for July 28th, 2026. I am Keith Harwood here for Yellow Tunnel and Tradespoon. Normal disclosures before we get started. Options involve substantial risk and are not suitable for all investors. Tradespoon, Yellow Tunnel, and myself are not investment advisors and not registered with the SEC nor FINRA. If you have questions about your own personal financial situation, please consult with a registered financial advisor. The information in this presentation is for education and information purposes only and should not be considered trading advice. All right. So we got more of this rotation market, tech down, broad market up a little bit, a lot of breadth improvements as the market's really basically just getting rid of those memory stocks that have been on such a tear. So higher risk tech going down, semis going down, and people buying other stuff, whether it's healthcare or consumer staples or financials. And so right now it's a tale of two markets. If I'm focused on the semiconductor space, I'm feeling very bearish right now. It's really not going well. Or if I'm a long-term investor, I may be looking to buy into this dip. I mean, Micron has found support recently around this $800 level. Will it hold again? We'll see. If it doesn't, I think that's just going to continue to weigh on the broad semiconductor market as well as tech. If I'm looking for stuff that's going up right now and actually being bought, I turn no further than looking at the financials or the healthcare stocks. So if I want to be buying things that are strong that the market's buying, that's the one strategy. The alternative is to look at the stuff that is getting hit as being a longer term investment because the timing may not be right, but I may not, but it may be dead on. I mean, we've had quick recoveries from some of these lows in the past. And if I don't want to feel like I'm missing out, I could consider buying this dip. But again, there's no indication to me right now that that's just going to turn on a dime. Maybe something the Fed says tomorrow changes that. All right. So with all that in mind, it's a question of probability of success versus return on capital on a broad scale. Probability of success is the stuff that's going up right now. Return on capital can come from a reversal in the move. It can also come in the form of looking for something that's going potentially to go from drifting higher to a parabolic change and going up more rapidly. The alternative on the probability of success is frankly just looking for stocks that don't look like they want to go down. Stuff that's not getting hit may not be getting bought, but it doesn't seem like it's going down at the very least. And so if it's not going down at the very least, take a look at a credit spread. If it looks vulnerable or correlated to semiconductor behavior, then it becomes vulnerable. Becomes a riskier trade. And I don't want to look at selling up a credit spread if I expect vulnerability to kick in. If the current trends continue, I want to look for stuff that's resilient to that, doesn't have a correlation to that. And correlations are generally pretty low for this broad market. So there's a lot of stocks out there that have no correlation to semiconductor price action or no correlation to healthcare action. Question is, can they all stay safe from Fed action? Yeah, I mean, the trend is rotation, on a big picture scale. Individual names, there are certain trends. Micron seems to be trending down. Had a bounce and a failure. Now the question is, can it find that support? Semiconductors had a bounce and a failure. Tech had a bounce and a failure. S&P seems to be bouncing. RSP, the equal weighted S&P, seems to be fine. If I'm looking for a major trend shift, I'd say turn no further than looking at the sectors that are bullish and maybe happened through all the month of July. So semiconductors have basically been bearish July. Financials have basically been bullish on July. All right. Long and short the market at the same time. Again, if I've got long financials and short semiconductors, that is not a market neutral position. Generally, that is two separate positions. If I've got long semiconductors and a hedge in tech, that is a hedged position. If I've got long semiconductors and short in utilities, I'm more likely to get scared off both because they have no correlation. When I'm looking for an investment thesis, pushing the expiration month forward certainly makes a lot of sense. If I'm looking for something just to try to capitalize in the short term, I can still look maybe for the rest of this week at August options. Then start moving towards September. I mean, I think that generally a good rule of thumb is to try to avoid options with less than 2 weeks till expiration when I'm buying, because the odds of success just are reduced significantly. Sure, the leverage is there. Oops. The leverage is there, but it doesn't give me a lot of time. Finally, being aware of those earnings dates. There's a handful of earnings this afternoon and tomorrow morning. Nothing that I see a really attractive trade opportunity, though. The more attractive trade opportunities may come with post-Fed big tech. So get Fed announcement out of the way, start up the news conference, and then let the market react to Apple, Amazon, Meta, etc., that are coming out tomorrow afternoon or Thursday afternoon. Okay. And I certainly don't like calling the bottom in semiconductors, but if I'm an investor and I've got a long time horizon, whether it's years or a year, it doesn't mean I can't buy it. It just means that I shouldn't expect it to rally this week, barring a big shift in the way the money flow is going. So stay flexible. Normal story there. Interest rates coming back down to 4.6. We'll see if that can fall low or if this is a full flag. Tomorrow's Fed will be telling on this. I don't think I'd put any weight into the technicals for today when we got the fundamental input tomorrow. So let's see what the market does tomorrow. It's like trying to trade the technicals the day before an earnings announcement. It's just kind of meaningless. But nonetheless, they are coming down. MMFI is actually a little bit firmer today. It was higher earlier. It's pulled back a little bit, still 57, a little bit better than neutral. So again, while people that are looking at semiconductors feel like this is a bloody market, overall it's not. We've gotten up to 59, nearly 60%, leaning bullish. We get up into this window and it starts to feel really bullish. So we'll see if the market can pull up some more names. Importantly, crude continues. So honestly, over the weekend, I was starting to get worried that this was going to get really bullish. Okay. The news of Ukraine getting involved in strikes, that seemed to be a problem. What happens if negotiations continue to stall or not exist? And then over the weekend after that, they said, okay, well, we're just going to put up a ceasefire and we're going to work towards negotiations. So the market starts to react as this expectation that, again, at some point this will get worked out. It's not going to happen. Not likely to happen quickly. Maybe it does. Maybe I'm surprised. I don't expect it to happen quickly, but the market is pulling away some of this risk premium of continued escalation and all-out war. So crude's back below 80. It's likely to struggle to get below 70, especially given that the last time it tried, it just simply rallied back. So without a real deal with Iran, I don't expect to see sub 70. Although, to be fair, I didn't expect to see below 70 a month ago. I think that the market was getting a little bit ahead of itself. And while I probably should have bought that break, I didn't. Because the market wasn't telling me to do so. It's kind of the difficulty with a fundamental market. It's almost somewhat required to be contrarian at times. The point of technical trading is not to be contrarian, it's just to go with the flow. So it can create a difficulty when there's a bias that doesn't align with the market behavior. And then finally, crypto pulling off today, a little bit of that risk off in tech. There's a correlation here with crypto seemingly resuming somewhat again, but it still didn't break out. It tried last week, wanted to get there, got to the 50-day moving average, and then just riding the 50-day moving average lower. I think around 60, maybe I can get convinced to potentially buy. Maybe it's 61, maybe it's 62. We're getting kind of close to that point. Otherwise, I've got to wait till it's above 67. So if I don't want to buy when we get these pullbacks, then I think the buy point that what would look to buy at that point is if we get above 67.5, we got to get above the June 15 high. Then that opens up the upside. If I want to buy it cheaper for some value and be able to sell if we recover to say 66.5 or 66, getting pretty close to that level. At 62, I could be risking 2 to make 4, right? I think that just below 60 is dangerous. I don't want to wait till it's all the way below 58 just in case. Buy's just not there yet, though. There's nothing clear here. There's better opportunities, clearer opportunities elsewhere. So the S&P again broke below the July 8th low last week, holding right now at 735. Somewhat surprisingly, creating this new support level. The cleaner support looked to be at 720, but we're starting to form this new support level at the 730 range. $8 lower than now, 1%. We got a lot of information coming out this week that could change this rapidly. Fed, as well as all the big earnings. So I'd say buyer beware. It may be the best buy, the greatest buy. We may see bullishness out post-Fed, bullishness for Apple and Amazon earnings that just drives this market higher, and we may see the other side. So it's risky. The VIX is sub 19, pulling back towards 18. It can get a lot higher if we start falling off a cliff, but we're not falling off a cliff. And if the market starts pushing back towards highs, I expect to see the VIX back to 15.5, 16 range. So potentially limited downside. Market's still not really moving all that much historically, but we may be approaching an inflection point where our movement's really going to be needed soon. Speaking of not moving much, there's small caps, boring. But it leads to some conversation about the non-tech sectors. Healthcare is up 2.5% today, breaking out to the upside. Financials breaking out to the upside, up 1% today. Consumer staples having a good day, up 2%. We've got materials up 2%. And then on the downside, we've got TAM, the solar ETF, down 5%. What else is down here? We've got uranium getting hit. So this is going to be bad for stocks like CCJ when uranium down 3.5%, bounced back to the 20-day moving average and then pulled back off of that. CCJ, my main go-to when I'm looking at a uranium type trade, looks basically dead on correlated to uranium, and I mean nothing else, but that's all it has to be correlated to. And then I mentioned before RSP, equal weighted S&P 500 is looking good. That's breaking out to the upside. So the S&P 500, as a reminder, is bouncing off of these support levels, while equal weighted S&P is now making a new high. Well, that's part of that market breadth improvement. That's part of that MMFI being 57 instead of 54 or 51 or 48. We're seeing buying in like these less interesting sectors, like communications up 2%. Stuff that people don't really want to talk about. Everybody just wants to talk about semiconductors. And semiconductors are down 3%, breaking below the July lows, on track for one of their worst months ever. Maybe break that 100-day moving average. To the downside here, maybe that finds a low here and starts to recover with a move back to 590. And that's only 10%. And we're normally moving about 3 or 4% per day. So it is a decent amount, but it's not like out of this world to think that a 10% move over the course of a couple of days could happen here. And because semiconductors are weak, of course, tech is down 0.75%. Also reaching the July lows, also testing the waters below the 100-day moving average. A lot of going there. And, for those that didn't catch it, NVIDIA is no longer the largest market cap company out there. NVIDIA, there you go, fundamentals, 4.76 trillion. And it's back to Apple, 4.95 trillion. So Apple had been behind NVIDIA. NVIDIA fell back behind, and Apple's back in the first seat. So just something to know. Because Apple's got earnings this week, Thursday after the close. And Amazon's got earnings this week, Thursday after the close. And, on that note, Meta's got earnings this week, Wednesday after the close. Microsoft, Wednesday after the close. We got a lot of big tech this week. It's going to be potentially very volatile for QQQ. So where do I go? I mean, I have to look for something else like XLU. That's still stable. I'm looking for something that's really not moving, but looks like it could get off the ground. XLU looks interesting. Duke Energy was one that we had for paid on Friday. Uh, Took up half today because it got up to 130, almost 133. Dominion Energy, that had been actually looking really strong about a week and a half ago, pulled back, recovered, but on these dips, it looks like a buying opportunity. Duke looks a little bit more dynamic. Dominion, though, has a range-bound trade where we're really close to that support level that we've continually seen bounces. For NextEra Energy, NextEra Energy has been grinding higher at a very slow rate, but it's got a trend. It's a slow trend. Certainly not like a go buy calls kind of trend, even though utilities tend to be lower volatility, and this is not doesn't need 5 or 10% to be profitable. The rate of this rally is pretty slow. So when we're near the lows of the trend channel around 88.5, it looks like a really good buy, and then around 91, it looks like a trend. Lather, rinse, repeat. That gives like a 3% range, which is all I really need. And the pace that this is rallying, just as a note, from June 28th, it's around 85.40, now 88.40. So it's about $3 a month, about 3% a month. But if I can buy near the low end of the trend channel and sell near the high end of the trend channel, I can capture that faster than a month. And I'm not going to make a lot of money buying and holding for a month for 3%, frankly. If I look out at the August 28th calls and I want to get, just using the low end of the trend channel, I'm going to be looking at probably around 92 as a price target. And if I buy an 89, 92 call spread for $1.40, sure, I may double my money. But it's not huge dynamic payout. If I just buy the $89 call, I'm effectively buying something just to break even. Rally's $3. These are worth $3. Or a little more than $3. I mean, they rallied 280 and these are worth $3.30. So small gain. Better to be in a call vertical, better to be in a spread than a stock that's moving that slowly in the uptrend. Let's run through the weekly power trader names. I like Bank of America. Being in the financials, it's good. It's got a positive trend. There's not a lot of pullback. The market just keeps building this position. Again, it's not moving fast necessarily, but it is moving to the upside. And we got a little bit of a consolidation window here. Post earnings, we had a little dip and then recovery, continued the upward trend, just went from the upper end of the trend channel to the lower end, and then continuing to push higher. And it just seems to want to keep going higher, frankly. We're going up at about, I don't know, $4 or $5 a month, a little faster than any. Picking up $1 a week works. I'm picking up $1 a week. Until the end of next week, that should be about $1.50. We'll trade at 64. The 62 calls can nearly double. Again, I could do a tight vertical, or I could just look for a little longer time frame on an option, whether it's August or even out to September. And then if I get $1.50 rally, look to take the exit. So like a $62.50 call on a $1.50 rally should go from 206 to 280, generate 30% return. That would be a reasonably nice payout. So yeah, generally I like Bank of America. It's not a spectacular trade, but it's a boring profit generating trade right now. Let me come back to blue. Just wrap these ones up real quick for you. So Devon Energy pulling back with oil prices. I'm reluctant to say that these things are going to just continue to collapse since we haven't really made real progress. It's just a pause. But overall, the oil market has surprised me on that with the magnitude of pulled back. Stocks like Devon, I think, could have some recovery, but for now, they haven't. 3M has been spectacular ever since earnings. And then today, it just rocketed. I mean, 2% now, but it was 4% earlier. It's just been a great return. It came up on Power Trader and Weekly Power Trader yesterday, and it turned out to be one of the better winners. It rallied so fast yesterday. I didn't feel like I could get into it, and I regret that now. I mean, felt like I missed it. So it bumped right on the open, then pulled back and stabilized around 177. Just felt like it was a missed trade. And then it picked up another five and on its peak of almost $9 today. Feel like it. It's one where the money flow is still going. But again, I feel like I missed it. I'm not going to add it. I think it's too late. Raytheon was on weekly yesterday and on aggressive today. This morning, it looked like it was running too much. Now, maybe there's a sign of, okay, it feels a little safer to buy, but it still has a 76 RSI. It's now showing signs that, it's one of those stocks where on the open, it's making a new high. I'm feeling like I'm chasing if I buy, but if it dips, it's telling me that some of that buying momentum has run out. So I don't want to buy it on a dip, and I don't want to buy it on a rally. And that means to me, I just don't want to buy it. Similar to Triple M, 3M. If it continues to rally, I feel like I would have been nice to be long, but I don't want to chase buy. And if it starts to dip, the buying momentum is waning. Maybe I don't want to buy after all. We got AT&T, aggressive and weekly power trader yesterday. Had good earnings, didn't have that full 70 RSI. It did have a really solid Friday and then just held near the highs yesterday, pushed through today. A nice run, similar to Duke Energy for paid. Took profits on half position today. I think that's the right call because at the end of the day, this rotation can always shift back the other way, especially with all the fundamental inputs coming. And then we have Thermo Fisher. Not quite as bullish as the rest of the healthcare sector, still up 2% today. Really good earnings, then a pullback, and then a bounce. Let's take a look at that Bloom Energy thought. Gosh, I mean, it's got earnings today after the close. Size here. Recently up to 30%. They've been bullish. We have pulled back. We're expecting 20%. These are all the difficulties with hedging for the earnings right now. It seems desirable to be long given the pullback we've had, right? And the generally bullish earnings that it has had in the past. Trying to think of what could be a problem here with their earnings. I mean, given their recent earnings history, bearish earnings is a minimal downside, especially from current price levels. Last time we were here and had earnings 3 months ago, we were actually a little higher and then just pushed a lot higher up to 285. Yeah, it's too far back even to go 2 years because prices have been so historically low that I think this is getting back to that spot of, I mean, there's very easy 20% upside here if earnings are bullish. That puts us back over 200. Options are expensive, so big open interest building on somebody. Looks like they're picking up the 180, 200 call spread today. That was kind of my initial thought. Maybe closing out those 165s, or maybe it's just active trading there. Yeah. I think the way I'd have to look at it is to say, look, it could go 30% up or down. More likely up than down. If it's going to go 30%, 15% to the downside seems like it would be a big move, which would put us back down around 20 to 25 bucks. So down around here, that 145 strike with the big OI. There's a ton of OI here, 155 that should generate some support, but it may be too close to at the money. Nothing below. It's difficult to necessarily set up a great hedge here. I think that part of the thought would be is there a price I'd be willing to buy more, even if it's bearish earnings? That's the question. If I'm long already, do I want to be hedged for what part of the move? Because it's basically just a structural hedge at this point. Is if I'm long for reasons that I want to own it, and my hedge is just to reduce the loss but stay long, and a simple debit spread to say, okay, I don't want to experience the loss from 160 to 150, but below 150, I'm ready to be long again. If I just want protection for the downside, I think replacing some stock with some call verticals could make sense. And then just taking that off and going back into stock if we go up. So like the idea being, if we bounce to 200 tomorrow after earnings, would I be exiting? And these are all like more just structural game plan trades, because at the end of the day, there may not be a huge edge on the options, but it's how would I want to make my trade look? Do I want to be long from here and take profits at 200? If so, I can replace some stock with call verticals. Then I've defined my risk to the premium I've paid. I certainly don't feel good about it if the stock drops $1 or rallies $1, but it gives me at least that defined risk, and that's what I'm paying for when I buy a put spread anyway. If I need a hedge all the way down to zero, then I probably shouldn't be long stock. If I just need a hedge for the move, if it goes below 160, I want to be reduced risk and then willing to buy back. If it goes to 150, that means I want to buy a 160, 150 put spread. Right? If I want to be out at 160 and not experience any more downside, if I buy a 160 put, I'm paying $14 for it. So I'm really kind of synthetically out at 146, right? The premium I'm paying means that I'm out at prices. If I can't stomach that downside to 145, though, I would have to do something. And my inclination would be to lean towards the call vertical, replacing some stock. So if let's say I've got 200 shares of stock, I either sell 100 shares and buy one, or probably one call vertical, or 170, 200. Now I'm risking $10 on instead of, so the same $1,000 as 100 shares for a $10 downside. I'm out at 160 effectively. I don't make any money if we go to 175, but if it comes out with good earnings and goes to 200, now I've captured a couple $1,000 profit, and it's not as much as it would have been if I was just long the stock, but at least I wasn't worried about a fall below 160. So, but didn't want to, then I think the other option is to sit there and say, okay, if not wanting to actually sell the stock, create a risk reversal, right? So long 200 shares, I buy one 160 put, and I sell one $200 call to finance it, because the 160 put on its own is just so expensive, $1,400. But if I sell a $200 call for $770, at least I've offset half the cost. And I picked 200 as like a price that I might be willing to just sell the stock if it got there. Right. Then my cash outlay is around $650 to have a hedge to the downside and a profit spot on the upside. Profit taking spot on the upside. It might just be a break even at that point, or might still be at a loss. And then ideally, we run to 190. Both options expire worthless, and I'm just back to long the stock. Yeah, so I mean, 155 put, same kind of concept. I could use that instead of the 160. It's just a matter of when I want to have my hedge kick in. Right? Would I rather be hedged if we go below 155? Because that's the danger point, right? Is we get below 155, that magnet actually could act as a springboard. I don't personally believe that this downside is down much below 145, but I've been proven wrong before. It just seems like there should be some support before then. And if the market still has long positioning, which they seem to have some, if not a ton, then I want to be able to feel, if it's basically just a matter of being able to sleep better at night and knowing that the losses are restricted to less than 10% of the stock price, then a 160 or a 155 put on the long side, and a hedge or a premium hedge of selling a 200 or even a 205 or a 210 call, however high I needed the stock to go in order to take profits and reduce my position. And then I can reevaluate. I mean, if we go to 200 and I get called away and I rebuy it for 200 or 195 or 210 in a week or two, so be it. But if I'm not willing to sell the stock at 200, because if it gets there, I want to ride it for that move to 280, then I can't sell the call. I'll call vertical as a hedge, saying I want to take in a little less premium, but be stopped back in if we get to 210, then at least I've reduced my premium paid for the put by $2. And again, I could reduce my premium paid for the put by selling a money put, like a 140, saying I'm confident that we're not getting below 140. So now I've reduced premium by selling a 140 put. If I buy a 155, sell a 140, I'm paying $5.40. I don't want it to happen, but it could triple in value. Ideally, it doesn't triple in value. Ideally, it goes to zero. And if $5.50 of premium is too much, then I've got to look to offset that total premium somewhere on the upside, or effectively say, I'll just sell a 130 put below the market. And if we go all the way down there, it means I'm adding to my position. Yeah, I mean, I see the point of the higher 50-day moving average up at 265, the 200-day moving average we just breached. Feels like we're going to have a tough time. Well, 235 would probably be a spot where we'll really struggle to get above, but 235 would be almost 50% move. It just doesn't seem realistic. I mean, we could get 30%, then we're going to 215 or 220. Am I okay getting out at 215 or 220? If the answer is no, I can't sell a call, right? If I'm comfortable with saying I got some relief and I'm out at 200, that's the level I sell the stock. I think at this point, like, if I want to stay long, but I want to have a hedge, I have to have a price point that I'm willing to sell on the upside if I want to sell a call to finance the hedge. And if not, I have to pick a strike below where I'm comfortable with that being fully long. So if it's a 165, 155 put spread, that only saves me for the first 8 to 10% downside. Below that, I'm just back to being long stock again. And if I want to be able to reduce that expense more, I have to pick a low strike that I'm willing to just say, if it gets down there, I'm happy to buy again, even if it's 130. Selling 130 put saves me $400, and I'm hoping it does. I hope I don't make that money, or I don't get to sign that on that option. But I have to be comfortable saying at 130, I'd be willing to add another 100 shares, even if the earnings are bad, you know? Yeah, exactly. I mean, it's if we go straight to the 165, 155 near at the money, um, it's effectively 1-to-1 risk reward, right? So if the stock goes from 170 to 175, and I've got the put spread plus 100 shares, I'm breaking even. If it goes to 145, I'm losing $25 a share on my stock and saving $5 on by having the hedge on. I mean, that's why I think, generally it's going to mean if I'm looking to protect, I have to have enough protection, enough return from the protection to make it worth my while. So I'm looking for ways to finance it. If I need to save myself $10 on the downside per share, then I have to have a $10 wide put spread, and then I have to figure out a way to reduce that expense that I just had to pay for that. So a 160, 150 put spread is $4. Okay, so where can I collect $4 more? I can either do it by saying at 130 I'm willing to buy the stock and sell that put for $4, increasing position, or I'm willing to take profits at 222.5, selling that call one time and finance the whole trade. And then anywhere between really here and 222.5, I'm breaking even. If we start falling, at least I've got a hedge to offset the loss. And if we rally beyond 222.5, I'm now taking off a portion of my position. So, it's one of those things where unfortunately it's really built upon what levels am I comfortable selling or buying the stock. And if I already own it, if there's no level that I want to buy more on the downside and no level that I want to sell on the upside, it might just mean that I need to trim some of the position in order to, uh, and as painful as it can be, just to say, I need to have some more freedom here, And if I'm comfortable with, well, let's say it's 200 shares, um, yeah, there could be some loss here. It could go to 150 or 145. I expect that 155 should create a nice floor, but if we break through the floor, the next real target seems to be 145. And then anything below that would just be wild day. But I mean, it happens, Yes, we're coming from recent lows, 3-month lows, but so it's not quite the same. But like IBM, when they pre-announced, they went from upper quadrant of the recent trading range to new lows for 6 months. That pre-announcement cost them $70 a share roughly. Same sort of thing could happen in Bloom Energy if they say the wrong thing tomorrow or tonight. I don't expect it, but it doesn't mean it's not going to happen. You know. So yeah, again, for me, it would be really about just trying to offset some of the premium paid for the hedge. And I think the answer would have to be, if I don't want to sell the stock here, if I wake up tomorrow and we're trading 222 or 225, and I have that short call, I think I'm still going to feel a little bit of relief, and then I can come back to it and trade with a clearer mind. I know it's where we were less than a week ago, but at least it gets me into a spot where I've got some flexibility again. So if I buy let's stick with that kind of original thought of like the 160, 150 put spread. It's $4. Sell the 222.5 call or the 220 call. I'm now paying nothing. I'm hedged. And if we happen to rally 35% on earnings and I end up getting called away from the stock, at least it's 35% higher than taking the risk off by just selling here, not being able to capture any of that upside, and not having any exposure. I think that's better than selling the stock. It's just a question of how comfortable am I if we do end up breaking through 150, 145, 140? Am I going to be panicking at that point? Because if so, put spread's not quite going to cut it. I just need that stop via an outright long put, and then I'm going to end up paying some premium for my hedge, even if I have the short call on the upside. Otherwise, I have to sell like a 185 call, which just seems too close for me to be comfortable with. You know? Back, let's just see what else we got on the signals from today. We've got GWW, which is WW Granger Industrials. They were good this morning, pulled back. It's a hard stock to trade at $1,400 a share, so I don't want to spend too much time on that. Raytheon, we already touched on. Schlumberger, I like less now than I did this morning. This morning, I actually really liked it. So the reason being, just had great earnings, ran up, and with oil prices down yesterday, it wasn't falling. Today, apparently, the oil price fall was enough to say the buying needs to stop for a moment. Some selling needs to come in. I think if oil prices are up tomorrow, even $2 or $3, that may get some really strong money flow back into SLB. But that's a derivative element. If oil prices drop another $4, the Schlumberger buyers probably continue to stay out of the way, right? Like they did in June. So it's a risky one with potential for upside to 54, 55, or potential for downside to 48 or 47. So with that, I mean, I tend to think long call. I was looking at the August 52 calls here this morning. I think they're an interesting way to play it at 95 cents, even at this morning they look better at about $1.50, but I mean, obviously they got cheaper. I think that's an interesting way to play it. I do think that there's some potential outsized payoff here. There is some big open interest at 52.5, but we don't have to go above 52.5 for those to be a winning trade. If we rally $2, these should be worth $1.75. If we rally 2.5, they should be worth about two. So it can turn into a winning trade even if 52.5 provides that resistance, as it did yesterday and Friday. It's tempting. It feels less lower confidence now, though, with the rate that it's been starting to fall throughout the day. Simon Property Group, there were a number of stocks. Simon Property Group, a little bit less of it, that had this big bump and then pullbacks today, where they were up 4%. Now they're down they're up 2%. Raytheon, 3M kind of come to mind. Raytheon actually negative now. 3M was up, as we talked about, 4-ish%, now up 2%. SPG is kind of the same thing. Could be a buying of this intraday dip opportunity. We're still on an island. We have the gap higher. People like this sector. They're going for real estate right now as interest rates are coming down. But I'm not sold on it personally. It seems like this move this morning is trying to be unwound to a certain extent. And then finally, Atlassian team, I love the way it looks. Their biggest problem is earnings in a week and a half. So if I'm going to trade it for a very short time, I'd have to use weekly options. August 7th has earnings in it. They're expensive as a result. Paying that earnings premium. It's a stock that often moves 12% on earnings and can move 30%, kind of similar to Bloom Energy in that regard. So paying a big option premium in order to do anything, unless I'm focused on just a couple of days, this week's weeklies, the 3-day options. So it's a tough long. I could buy it for the week, just buy some short-term calls and risk the money, or I can sit by and let it pass. And I'm choosing to let it pass. But teach their own, because the earnings premium is just so much that it makes it hard to make money on it, even if the direction's right leading into earnings. All right. All right. So that's kind of the view for me on this. Just a couple to note that have earnings today. I don't see a trade here. Seagate Technologies is down 8% today. It's in that semiconductor space. I think it's important to watch. Maybe not so important as Apple, Amazon, Meta, Microsoft. But this is a stock that has moved 11% on average over the last 2 years. We've had 20% moves. It's in the semiconductor space. If it has a bullish earnings, that may help save some of this market. Fundamentally, it's only a $185 billion company, so it's not nearly the size of a Micron or, Microsoft, Meta, Apple. But getting some good news for semiconductors, I think, would be very important. And if it comes in with bad news on earnings, that could be equally problem. That could be a big problem that this market is ready to pile down on the selling of semiconductors if it's weak. So I think it's going to be an important earnings in many ways, just because of the vulnerability of semiconductors at the moment. But I don't see a trade there. You got Visa, earnings wise. It's historically been a non-mover, but the last earnings we moved 8%. So it makes it hard to make a trade there. Usually 2% moving kind of stock, I'd say, yeah, I could look for an iron conduit, but we just moved 8%. And yeah, we pulled back over the course of a week. Just kind of need a reset here, get through another earnings before starting to look for predictable moves again. KLA 10 core, similar to STX, and that I think it's going to be an important one to watch, but not necessarily something I want to trade. Same idea as Visa, where it normally moves small, but it has recently had a big move in January. And so again, I don't see anything predictable in the earnings, more watch and see. We got SoFi. Another one that may be indicative of what's going on, especially with Korean money. Last earnings was really bad, down 15%. Another looks another one that looks to be a watch and see. We don't have a predictable earnings move, but we'll see if that has an impact on the market. Now, Boston Scientific, I'm intrigued. It had for a long time been a 4% stock. The last two earnings, we have really bad and then pretty good. Stock's coming off below and starting to recover. And I like the idea of Boston Scientific. In the past, when it's had trends, it trends. And I got to go more than 2 years. From 22 till 25, basically a 2.5 year long trend. This year, we've had 6 months almost straight down, unwinding 2.5 years of rally. Went up the stairs, down the elevator. Can it go back into that bull trend? That's the big question mark. And if it's got bullish earnings, I think that just sets up a longer term bull view for an investment thesis. If it's got bearish earnings, it's not there yet. So rather than looking to trade the earnings, I think it's trade what or ahead of the earnings. I think it's react to the earnings. We have these windows where we just kind of bump up and then fall, bump up and then fall, bump up ahead of earnings. May just be setting up for another fall. I don't see again anything predictable, but I think there's a reactive trade. ESX can get to 50 or 51 on earnings, and maybe setting up for a longer term bullish view. And then ADP, generally just one again to watch for indications of the economy, payroll provider, data processing, really good earnings in April. Previously, it's a 2% mover. The last 9 months, it's been a little more volatile, 7%, 2%, 8%. Maybe we go back to 2%, we go back to 8%. Nothing predictable here. Not worth deploying capital in something that's unpredictable in my view. All right. Yeah, TJ Maxx, let's see what we got. Out of this range after the gap down, the gap fill looks to be 164. Toolbox will update tonight on it, but it was leaning towards bump and then stable, but not quite to this level. It's looking for 160, maybe 164 by July 30th. So kind of at the peak of where it was expecting we could get today. Didn't have the pullback basically, so I was expecting bump and then fade. We bumped without the fade. It's pretty symmetrical risk reward. About risking $3 to make 3.5 maybe. So slightly positive expected value on the long side. So I'd look for a profit target around 164. Stop out if we got below about 157, 157.5, somewhere in this range. Earnings in 3 weeks, so I don't see anything there. It's been a trend long. If I go into longer time frames with some of these dips, this one kind of reminds me of what we're seeing here, where you get down to the 200-day moving average and then you push away, down to the 200-day moving average, test below, then push back off. But so technically, it kind of looks like a repeat of this pattern of test it and then bump off. But the earnings, if in 3 weeks, may change that. I think in the short term, I'd lean bullish towards 164.5, 164.5, but not one to hold through earnings. So is that worth doing anything? 2.5% rally in 3 weeks. If I'm right, I mean, that's not bad, but it's not like a long call position. 160s, I basically make a small amount of money. 160, 165 call spread, at least then I'm risking 2 to make 2.5. About the same as I'd be risking in the stock, risking 3 to make 3.5. Slightly better in the options, not by much. Probably better in just stock, honestly, because that incremental reward only occurs in the bullish case. I lose money if we only go up 50 cents, right? Versus the stock, I make a little bit of money if we go up 50 cents. It's a stock trade if you're a stock trader. So if I'm a stock trader, I can look to buy it Look for a route of 164.5. That's about all she wrote. Now, I could also look at the stock replacement, buy a 150 call instead of buying 100 shares for $16,000. I got 100 shares of exposure for 1 grand. No, sorry, 1,000 times $1,000. Sorry, not 11 grand, 1,100. So that's how I get the leverage. Is I get the $100 or 100 shares of exposure for $1,100 instead of $16,000. But other than that, it's more. I don't see anything that's like spectacularly interesting from the option side of things. For structuring something nearer to the at the monies using call verticals, etc. I think it's more of a just stock or stock replacement. Right. Not much else I see that's major today. Just a couple notes. UPS had weak earnings. They've been consolidating, and the earnings pulled it down 6% today. Consolidating, Rally, Bellfall, Berkshire, Day up 3%. Coke had good earnings, up 5%. So this is some of that consumer. I mean, Coke is the consumer staples rally there. And other than that, there's not a lot of big name stocks that are particularly interesting, frankly. All right. All right. So with that, I will let you guys go. Best of luck for those with earnings exposure, et cetera. And, start getting ready for the Fed tomorrow afternoon. We'll see what they do and then big tech earnings. All right. Thanks, everyone.